I'd like to thank you all for joining me today. I know I'm up against March Madness playing on a various variety of different screens, so I know that's a big pull for people. And also lunchtime, so I appreciate you being here. Today we're going to be talking about estate and succession planning for business owners. For those of you who don't know me, my name is Jason Parashow. I was born and raised in Stockton and have spent most of my life here. I'm currently an attorney with Kroloff, Belcher, Smart, Perry, and Christofferson here in Stockton. And my practice areas generally include estate planning, trust administration, probate, general business law, including real estate transactions, transactions involving the selling of businesses, et cetera, and also certain tax matters. So I do a lot of collection matters, offers and compromise, installment agreements with the IRS and other taxing authorities as well. I also speak Spanish fluently, and so that's been a big help for me to increase the number of clients that I'm able to reach, and it's a lot of fun to put those skills to use in my practice. So that's a little bit about me. Any attorney presentation would not be complete without the standard disclaimer. So my intent in doing this presentation is to generally provide sort of an overview or general informational advice. It's not intended to be a one-size-fit-all for everybody. Of course, everybody's situation is going to be different. And after the presentation, if you do have questions about your respective circumstances or might need to talk a little bit more about that, certainly give me a call or your own counsel if you have one already to discuss those issues. Okay, now that our behinds are covered, we'll go ahead and get started. Today we're going to be talking about a number of different topics. I think it's important to start with just a summary of individual estate planning and some of the issues that are associated with that. A lot of you might already have your estate plan in place, but for those who don't, I think it's kind of the building block that we're going to be using today to build the presentation. Proposition 19, I threw that in there because I'm still getting a lot of questions about what the effects of Proposition 19 are. It doesn't directly relate to what we're talking about generally, but I think some of you might find it useful, so we'll briefly touch on that. And then we'll get into talking about sort of tips and tricks for planning for family-owned businesses, especially when we're talking about succession plans and maybe the next generation taking over in the future. We'll spend some time going through what a buy-sell agreement is and why it might be important or a good idea to institute in your particular business. And then finally, we'll end up with just a review of estate tax and gift tax and some of the issues that stem from that. Okay, so getting started with individual estate plans and related issues. Again, this might be review for some of you, but typically the average family estate plan would consist of a will. A will is a document that, quote unquote, speaks on death, in that you execute it and then the terms are carried out upon the decedent's death. Typically, a will would dispose of personal property to either a named beneficiary or in many cases would be a pour-over will, meaning that the property that's not designated would just pour over into the revocable trust and be distributed that way. Another common thing in a will is people with minor children can name a guardian that they choose to be basically named as the guardian of their minor children in the event of their death. The revocable trust is kind of the cornerstone of an estate plan. We'll see in just a minute some of the reasons a revocable trust is very important. But generally, a trust would hold real property assets, business assets, high value bank accounts and stock accounts, things of that nature. And the next slide, you'll see exactly what a trust is and does. An advance directive is also known as a medical power of attorney. And that is important because once you do an advance directive, you have appointed an agent to act on your behalf in the event that you're not able to. If you're in a hospital and not able to make your own decisions, you've already spelled out your wishes as far as resuscitation, organ donation, disposition of remains, and also given your agent the authority to interact with medical staff and receive information to make an informed decision. Another common part of the estate plan would be a power of attorney for financial purposes. So in this document, the person would name an agent to basically step into their shoes and be able to deal with financial assets or other assets that are not titled in the name of a trust in the event of that person's incapacity. Once a trust and an estate plan is set up, it's very important. The second phase is kind of the funding phase. So it's important that the appropriate assets are transferred into the name of a trust. So with real property, typically an individual owner would transfer the property into their trust with themselves as trustee. It would be held that way with a transfer deed. Same thing with business interests. We'll see in a minute that is very important to put either your shares in your closely held corporation or your partnership interest or LLC membership interest into your trust and hold it that way. Along the way, if you have any questions, please, you can type them into the chat box, and I think we should have some time at the very end. I can go through those and answer those. So I get this question a lot. Why do I need an estate plan? I'm not a particularly wealthy individual. Is it even necessary? Well, there's several different reasons why an estate plan is very crucial to most people. First and foremost, you can avoid probate if your estate plan is set up and funded properly. I think the next slide will go through what probate is and why it should be avoided. Another benefit to an estate plan is that you are able to plan for incapacity in the event that something happens during your life and you're not able to act on your own behalf. You've already named somebody to step into your shoes and be able to sell property or rent out property, deposit, withdraw, really anything that you can do yourself with respect to property, that person would be able to do for your benefit. And lastly, the estate plan is a way to clearly describe how you want your estate distributed upon your death and to enumerate the terms of distribution. So it doesn't have to be just a straight distribution outright to a beneficiary. You have the option, especially with minor beneficiaries, to hold their share in trust, if you like, until they reach certain milestones. One common one is, at 25 years old, they get half of the trust estate that's coming to them. And then at 30, they would receive the remainder outright. And of course, during that time, until they get the assets outright, the trustee of the trust would be able to distribute income and principal to that beneficiary for their education, support, and maintenance up to their discretion. So I talked earlier about probate. Probate is kind of a sort of a dirty word in estate planning circles. It's something that is necessary in many cases, but also something that's totally avoidable and unnecessary if proper planning is done. So a probate is a court proceeding whereby the debts or the creditors of an estate are paid off, and then the remainder of the estate is distributed either to the beneficiaries named in the will or to the intestate heirs according to the California Code. So in general, if an estate has a total date of death value that's greater than $166,250, and that's gross value we're talking about, then a probate would be required in order to administer that estate and get it passed down to the next generation beneficiaries. There are a lot of assets that are excluded from that number. As I touched on before, any asset that's held in a revocable trust, which means for real property recorded with a deed to the trust or held in a bank account in the trust name, those assets would not count towards that figure. Similarly, joint tenancy assets, either bank accounts or real property that are held as a joint tenant, would automatically pass upon an owner's death to the surviving joint tenant or joint tenants and would not be subject to probate. Any asset that would pass to a surviving spouse is not included in that number. And pay on death accounts, so life insurance, 401ks, IRAs, some annuity type accounts that have a beneficiary designated on the account would just automatically pass to that beneficiary upon the account holder's death. Now, the one caveat to that is if no beneficiary has been designated with the company that holds the policy, or if the owner has designated that their estate is to receive the asset upon their death, then in that case, a probate would unfortunately be necessary. And then finally, some vehicles and mobile homes are generally not included in that number. So a probate, as I said before, it is a good way to administer certain estates, but especially during COVID times, the best case scenario, you're looking at probably a year to administer. And depending on the size of the estate, it could be very costly in attorney's fees and filing fees to get there. So it is something that's totally avoidable if proper planning is done. Okay, so now let's get into a little bit deeper into what a revocable living trust is. So the settlor, or the person that sets up the trust, typically serves as the initial trustee, meaning that they're in control of the trust and have full discretion to act on behalf of the trust with those trust assets. It's still their assets, even though it's not titled in their name individually. It's in their trust, but they still can sell, refinance, mortgage, lend, borrow, anything that they could do with their individual assets, they could handle as the trustee. A revocable living trust can be amended, terminated, or revoked at any time by the settlor, the person setting up the trust, as long as the settlor has the legal capacity to make those decisions. We see this all the time where someone sets up a trust and then 5 years down the line, maybe the beneficiaries they named are no longer in their life, or they're not on speaking terms. They can come in and amend the terms of the trust and choose different beneficiaries or a different trustee. It's very common. A living trust also names a successor trustee, or ideally several successor trustees, to serve in the event that the initial trustee settlor is unable to, either through incapacity or death. That's already lined up in the trust document, and someone's waiting in the wings to fulfill that. In the trust, the settlor has really wide discretion to determine how their estate is going to be distributed. They can choose to give percentage interest to different people or organizations, specific assets, specific dollar amounts. We've even done, pet trusts. You hear about those sometimes, where an owner's cat gets $5 million. That's kind of an exaggerated example, but a lot of people do want to provide for pets and charities, and so that's certainly a consideration. The trustee would actually be the one handling the distribution of the assets pursuant to the terms of the trust upon death. And if everything's titled properly, no probate proceeding or court oversight would be required. So that's a huge plus. Okay, so let's transition now to Proposition 19. We'll just spend a couple minutes on this just to make sure everybody kind of has a grasp on what we're talking about. So Proposition 19 was on the ballot last November. I think it passed with 51%, so it was a very close vote. This proposition has to do with property tax valuations upon parent to child, and grandparent to grandchild transfers of real property. So it used to be, before Prop 19 was in effect, there was no value limit for any transfer of a principal residence from a parent to a child or a grandparent to a grandchild. The property tax valuation would stay the same when the child inherited the property or was gifted the property. It also used to be that with respect to other property that's not a principal residence, those properties could be transferred and maintain the same property tax value as long as the lifetime limit of $1 million of the base year value cumulative for all the properties transferred didn't exceed that number. So that was very helpful formerly. You'll see there's a stark contrast now. The law took effect as of February 16th of this year, and it's quite a bit different, as you'll see. So with regard to principal residences, there is still an exclusion, but the caveat is both the transferor and the transferee must use that house as their principal residence. If the transferee does not use the house as the principal residence, then the property will be reappraised for property tax purposes, and the property tax bill is going to go up to current levels. Likewise, there is a limit on the transfer of principal residence. So the taxable value of the property at the time of the transfer plus 1 million is sort of the threshold for determining whether the exclusion will apply. So any principal residence that has a fair market value above that would still be subject to reappraisal. And then the big one is with respect to other property, rental property, vacation property, bare land, ag land, there's no exclusion available for other property. So upon transfer from a parent to a child or a grandparent to a grandchild, it would simply be reassessed for property tax purposes. And we'll see with this next slide, I've kind of just broken down a quick example just to kind of bring this into real world terms. So let's just say that Melissa bought a principal residence in 1980. The annual property taxes are currently $3,000 a year. And then in 1990, she bought a cabin in Tahoe. The property taxes are currently $5,000 a year. Upon Melissa's death, her daughter Kendall inherits both properties. So with respect to the principal residence, unless Kendall uses the home as her principal residence too, that property will be reassessed for property tax purposes, and the tax bill is going to be going up significantly. Even if Kendall does reside in that residence, the home's fair market value cannot exceed the base year property tax value in effect at the time of transfer plus $1 million. And then poor Kendall, with respect to the Tahoe cabin, she's sort of out of luck because the property will be reassessed to current property tax values. This is one of those things that's going to have big implications in the future. I think the general member of society doesn't really grasp what this means. And I think people are going to have a big surprise down the line when these transfers happen. So that's just a quick review of Prop 19. Okay, now let's get into the meat and potatoes of the presentation, proper planning for family-owned businesses. So I think in dealing with family-owned businesses, I think it's never too early to start thinking about your succession plan, be that retirement, disability, or in the event of the owner's death. I think not enough business owners really sit down and think, what are the goals and opportunities for this business, long-term and short-term, talking with family members regarding their plans for the future. I think a lot of times there might be assumptions on who's going to be running the business in the absence of the owner in the future. But I think it's very important for all business owners to sort of sit down and have that talk. Do your kids want to be involved in the business? Are they looking to forge their own way and get involved in something else in a different part of the country or a different industry? And maybe they don't want to be in the business. And so I think that's important to know as early as possible so that the owner is able to use that information to inform their decision. Even if the next generation wants to be involved in the business, in what capacity will they be involved? Are they looking to just simply be an employee, or are they looking to take over management someday, or simply have an economic interest, cash the check when it comes in. Assuming none of the family members of an owner want to keep the business going, I think it's important to identify who is going to be running that business after the owner retires or dies. Sometimes long-term employees are interested in maybe taking the reins and running with it. Oftentimes that's a good solution because they've already been trained or coached on the ins and outs of the business. They know the clientele, they know the distributors and suppliers. But any way you slice it, I think it's really important to start training anybody that's identified as a potential successor as soon as possible, so that there's no panic mode when there's a change of ownership. For some businesses, it really makes sense to explore the possibility of selling to a third party. You know, if someone's family members or close employees are not interested in carrying on the business, perhaps a sale now and passing on the proceeds to the next generation is the best way to go. And then also going back to the transition that we were talking about earlier, it's very important that business interests are titled in the name of a trust so that there's a smooth transition either during life through gifting or upon death, which is where the trust would come into play with the distribution provisions and or a buy-sell agreement, which we'll talk about now. So what is a buy-sell agreement? A buy-sell agreement typically provides for a smooth transition of ownership interests upon the occurrence of a triggering event. And in the next slide, I'll show you what some of those triggering events might be. But in a nutshell, a buy-sell agreement is either an agreement between the business entity, whether it be a corporation, partnership, or LLC, and the individual shareholders or partners or members, or it can be an agreement between just the owners, the individual shareholders or the members of an LLC or the partners in a partnership. So there's many different buy-sell agreements out there. I'll just kind of hit some of the important goals that are usually in most buy-sell agreements. One of them is that the agreement sets forth the rules that govern permitted transfers. You can imagine if you're in business with a couple of different people, you don't necessarily want to be in business with their cousin if they inherit a business owner's interest down the road, or somebody that you have no experience with. You want to kind of limit who gets to be part of that business if it's a very closely held business. It also provides a mechanism for resolving disputes, usually via arbitration. The main goal is to ensure that the management and control, there's a continuity there, that there's not going to be a drop-off or people going into panic mode and, what do we do now? Everything's already agreed upon ahead of time, and the buy-sell agreement would be consulted with respect to those terms. Another important feature is that usually a buy-sell agreement would contain methodology for valuing the shares or the interest to be transferred. I think usually buy-sell agreements are standalone. That's how I've most commonly done them or seen them. But I have also seen buy-sell terms incorporated into corporations' bylaws or into the partnership agreement or LLC membership agreement, operating agreement. So here are some of the events that might trigger a buyout of a business interest. And again, it'll depend on the actual terms of the buy-sell, but one common one is the death of an owner. So upon the death of an owner, how is that owner's interest purchased by either the business entity or the other members or shareholders of the entity? Permanent disability is another common one. If someone is no longer able to function in their normal capacity with respect to how they usually were interfacing with the business, oftentimes it makes sense to compensate that person by buying out their shares and giving them some liquidity to deal with their disability down the road. Divorce is another common one. I think most people would agree that if one of your co-owners were to divorce, you would rather not be in business with the ex-spouse of that co-owner. You know, generally speaking, in some instances it might work out, but that's another common one that is in a buy-sell agreement. Bankruptcy or insolvency declarations as to an owner can also trigger a buyout, a mandatory selling of shares or membership interest by the bankrupt individual, which will have the effect of protecting the business and the other owners of the business from potential creditor issues and things like that. Attempts to sell to an unpermitted party, we touched on that earlier, but generally a buy-sell agreement would spell out who can be a permitted party within the organization and the rules for the sales of interest to a third party or others. Retirement is another one that's covered in a buy-sell. What happens if an owner wants to get out? Is there an agreed upon price that their shares can be purchased for? You know, what are the terms of the payout, et cetera? And then finally, sometimes buy-sells contemplate what happens if one of the owners ends up pledging their shares as collateral or in some way encumbering those shares. That can have impact on the business as a whole. And so that can be built into an agreement as well. So there are many different ways in a buy-sell agreement to sort of set forth what the selling owner's shares or membership interest should be to value those shares. So I have seen all of these. I think some are certainly better than others, and I'll kind of walk you through them. Sometimes the owners want to put just a hard number in the agreement. So, you know, say that our business is worth $500,000. There's two shareholders. Upon either of our deaths, the surviving shareholder owes the other one's estate $250,000, for example. I don't like this approach very much because obviously economic conditions and conditions with respect to the particular business change frequently, and this tends to pigeonhole both parties either undervaluing or overvaluing the interest based on a price that may not be fair at the time that it's needed. A lot of people also choose to just put a standard value down in the agreement and agree to review periodically the fair market value every 1 to 2 years. I can tell you in practice that this is rarely followed. It's one of those things that kind of slips through the crack, kind of like the annual meeting of shareholders, which I know a lot of people just sort of forget about and don't do. And this is another one that fits that category. I think it's better to put some sort of formula for valuing those interests or shares in the actual agreement so that everybody's on board, and that allows for variances as the revenue either increases or decreases over time. So one example of a formula would be valuing the total company as 2 times the annual gross revenue for the last calendar year, for example, adding in the value of all assets and subtracting the value of liabilities, and then dividing that amount by the number of membership interest or shares in the entity to figure out what the fair sales price would be. So I like that one. This one, as the parties agree when the time arises, you know, everybody's friends until, you know, it comes down to it and it's time to fix the actual valuation. I don't think this one is particularly useful. I think it's much better to put some sort of mechanism by which the interest will be valued as opposed to just agreeing to agree at a future date. A lot of agreements spell out that either one appraiser that both parties agree to will be in charge of valuing the interest and going that route. Sometimes it's a situation where the deceased owner's estate or next of kin would choose one appraiser the business entity would choose another appraiser, and then you would compare those two appraisals and see if they're close. If not, then maybe a third appraiser can be brought in to value the business interests and kind of break the tie. So there's many ways to do it, some much better than others. So let's just review just a quick example. This assumes that a business owner has died, and the buy-sell agreement spells out the terms of the purchase of the deceased owner's interest. So one common way to do this is a redemption by the business entity itself, be that the corporation or the partnership or LLC. If there's sufficient capital, maybe a lump sum payout is an option. Oftentimes that is not an option, and a more common way to deal with this is to actually fund the buyout by purchasing term life insurance. So in this case, in a redemption scenario, the business entity would actually purchase term life insurance policies on each of the owners. And then in the event of an owner's death, the policy would be funded, and the corporation or other business entity would use those funds to buy out the deceased owner's interest. And this is a great way to provide liquidity in the event that there's insufficient capital to pay for that interest outright. Another common one is a cross-purchase agreement among the shareholders or the members of the business entity. Just like a redemption, this would be funded by term life insurance policies on the lives of each of the other owners. You can see where this scenario would usually be best when there's 2 to 3 owners. You wouldn't want a situation with 15 owners, everybody getting cross policies on everybody else. It might be a little untenable. But the same thing applies here with the cross purchase agreement. One owner dies, the policy taken out by the other owner is funded, and then those proceeds are used to purchase the deceased owner's interest. And then finally, another way to do it is if you're not funding with life insurance, you can put in there, whatever the valuation is will be paid over 5 years, for example, in quarterly payments with 3% interest, whatever the terms may be. Okay, so we talked earlier about permitted transferees and unauthorized individuals. Generally, buy-sells permit transfers to a revocable trust of an owner, sometimes to the lineal descendants of an owner, or transfers of interest to existing co-owners. In the event that an owner receives an offer to purchase his or her interest from a third party that's not part of the business, there are usually some protections built into a buy-sell agreement that allow the business entity to have the first right of refusal to purchase those shares on the same terms as the offer made by the third party. So typically they would have 30 to 60 days at the business entity level to determine, okay, do we want to buy these shares? Is this a minority interest versus a majority interest? What happens if we don't buy the shares? Is it going to negatively affect our business? In the event that the business entity decides not to purchase those at the corporate or partnership or LLC level, then the other owners would have a second crack at buying those shares, usually in a pro rata ratio to the ownership that they hold of the total shares or business interest. And then if they pass as well and decide, you know what, we just don't want to spend any more money on this interest, then the third party owner can purchase the shares or business interest. But usually the buy-sell agreement will limit that person's interest in the company to an economic interest, whereby that person wouldn't have managerial control or voting interests necessarily unless authorized by the other owners. So there's a lot of protections there that are very useful. Okay, now we'll transition to estate tax and gifting. I think there's generally a lot of misconception out there Maybe not so much in the last couple of years because the exemption amount is so high, as we'll see in a minute. But you know, last 15 years, every couple of years, this will be a hot button issue in Congress, and depending on who was president, you know, getting people all riled up about death taxes and paying taxes upon death. I'm here to tell you that you know, 99% of people out there right now, as it stands today, will not have to deal with estate tax or gift tax. But we'll just kind of walk through this real quick. So for 2021, there's a lifetime estate and gift tax exemption, all rolled up into one. It's a unified credit of 11.7 million per person for both estate and gifting. For a married couple, that's 23.4 million of the exemption. That means that if you're a single individual and you pass away and you have an $11 million estate, you're not going to be paying any tax to move those assets to the next generation because you're not above the exemption limit. Estate tax is only assessed in situations where an estate would be valued more than the exemption amount. Similarly, gift tax would only apply to lifetime gifts in excess of that 11.7 million or 23.4 million for married couple exemption amount. So most people are not going to have to deal with this, but it is important to go over because there very well could be changes in the future that will make this more of an issue for a lot of people. In the event that estate or gift tax is due, the percentages range from 18 to 40% tax rate at the very top. So it is very expensive and should be avoided when possible. As I alluded to before, changes to the lifetime unified credit, the exemption amount is set to expire automatically in 2025 and revert back to 5.49 million unless Congress affirmatively acts otherwise. In the last 15 years, the exemption amount is kind of ping-pong balled around. I think $2 million was the 2003 amount, and then it went up from there and went back down and so forth. So this is an ever-changing exemption amount, and you should keep on top of this because if it goes down even back to $2 million, it's going to impact a lot of people, and some gifting might be a good idea in those scenarios. One advantage to having the exemption amount so high right now is that as long as this exemption amount is in effect, someone can lock in this exemption amount of 11.7 per person through gifting during their life, even if in the future the exemption amount is reduced or even done away with completely, which is probably unlikely, but certainly is a possibility. So if someone were to have a large estate and take advantage of the $11.7 million gifting, for example, during a lifetime, even if the exemption amount is lowered in the future, it doesn't take away those gifts. It's still out of that person's estate and will very likely help eliminate or reduce estate tax to that person in the future. For gifting purposes, there's also a separate annual gift tax exclusion amount. This applies to gifts of up to $15,000 from any one donor to any recipient each year. So if someone has 6 kids, that means they can give $15,000 to each of those kids each year without even going into their lifetime exemption amount. It's just an annual exclusion. Nobody's going to pay tax on that gift. No gift tax turn is due. And it's a great way to provide for your family and also get assets out of your estate. Spouses can give up to $30,000 per year as a split gift to any one recipient. So same thing applies. The only way a gift tax return would be due is if you gave an amount over $15,000 to a certain person in a year. This would not trigger any gift tax to be due unless you used up your lifetime exemption that we alluded to before, which is fairly unlikely for most people. But you would still have to file a gift tax return just to track that lifetime gifting amount for the IRS. This $15,000 number is tied to inflation, and so it increases slightly over time. I think a couple years ago it was 14,000, and maybe next year, the year after, it'll probably go up to 16,000. So it's tied to inflation, and it does increase a little bit over time. So getting back to differentiating between the annual and lifetime exclusions and exemptions, this is just a review of how those are different. The gifting, of course, is included with the estate tax portion in the unified credit. And so someone can either give away up to 11.7 million during their life, and that would account towards the exemption as a gift, or whatever remaining exemption amount is left can be used upon death to pass assets to the next generation tax-free. Okay, so let's talk about a little bit about the advantages and disadvantages of gifting during life as opposed to through your trust upon death. So some of the advantages of the lifetime gifts are, as I said before, you lock in the current exemption amount, which is really high. I don't see that $11.7 million number going any higher, except for small increases tied to inflation. But I don't think Congress is going to affirmatively act to raise that number anytime soon. If anything, it will go down. So for those people with large estates, it's very important that you lock in that exemption amount while it's still so high, so that you get that benefit. Direct payments either to colleges or to hospitals on behalf of a beneficiary, child or grandchild, don't count towards that lifetime exemption amount, as long as the beneficiary does not have direct access or control to the money, and it's paid directly to the hospital to pay for medical bills, for example, or to a college for tuition expenses. It would not count towards that lifetime exemption amount. Valuation discounts it's a very dense topic, but I'll just kind of touch on it real quick here. If you're gifting or transferring partial real estate interests or even business interests that are fractional interest, 10%, 15%, et cetera, the value of those interests can be discounted, both for lack of control in the case of a minority interest, or for lack of marketability. So if you have a closely held corporation with two shareholders, and one shareholder has 15% interest, and they want to sell to a third party or transfer to their kid, it's generally not going to be valued as 15% of the whole valuation of the company. There's going to be a discount because it's not real marketable. In a closely held corporation, there's not a market generally for people scrambling to buy fractional interest there. I've seen combined discounts for lack of control and marketability in the 30 to 50% range sometimes, which is very important because it allows you to discount the value of the gift, which means that less of an amount is counting towards your lifetime exemption amount, and it still is allowed to appreciate in the beneficiary's estate and not in yours. Transferring appreciating assets to a family member during life is another good strategy, because not only are you getting those assets out of your estate for potential estate tax purposes down the line, if they're continuing to appreciate over time, you've transferred an asset that might be worth, let's say, $2 million today, but is going to be worth $5 million in the future. So you're taking that $2 million credit and applying that towards your lifetime gift exemption or transfer exemption, even though it's going to be worth much more in the future. So there are disadvantages to lifetime gifts, one of which is the tax basis. So whatever the recipient's, whatever the donor's tax basis is, usually the purchase price for the asset would be inherited by the recipient for any gift that is made. This can have big effects if Let's say someone has a house that they've had for 30 years. They paid $50,000 for it. Now it's worth $1 million. The recipient, his or her tax basis would be $50,000, and that'll have big effects if and when they go to sell the house, because that's going to determine the amount of gain that they're paying tax on. The other big one is that with lifetime gifts as opposed to transfers upon death, the recipient would lose out on the step up in the income tax basis on the owner's death. So if someone were to keep an asset in their estate and then pass it to the next generation through their trust, upon that person's death, their estate is quote unquote stepped up to fair market value for the tax basis. So I think the next slide we have an example of that, but that's a big one, and you'll see why in just a minute. Okay, so here's another little example. Let's say Larry purchased a vacation home in 1970 for $300,000. That home is now worth $2.5 million. Let's just assume that when Larry dies, it'll be worth $5 million. So the purpose of this example is to show you the difference between a lifetime gift, if Larry were to pass that along to his son now, and a transfer on death to his son, who I've named Terrence. So if Larry were to gift that asset during his life, the advantages are the home is no longer part of Larry's estate for estate tax purposes. So he's less likely to pay estate tax depending on his other assets and where the exemption amount is. And the other nice thing is, due to continuing appreciation, Larry's gift of $2.5 million is worth $5 million to Terrence down the road. So it's appreciated while in Terrence's estate and not Larry's. However, the downside is that Terrence has inherited the $300,000 tax basis, which is what Larry purchased the home for. And if Terrence were to turn around and sell that home for whatever the fair market value is at the time, he would be paying some pretty hefty capital gains calculated on the difference between the sales price and that basis. So in this scenario, that would be $2.2 million would be the gain, and he'd be paying capital gains on that amount. Let's contrast that to if Larry decided to keep that house in the estate and transfer to Terrence upon death. The home's fair market value is now $5 million, and that amount counts towards Larry's lifetime estate tax exemption. So instead of $2.5 million, it's now $5 million, which, depending on his particular circumstances, could be the difference between paying estate tax and not. It's much more likely that he will, especially with the reduction in the exemption amount. However, the Terrence will benefit from a stepped up tax basis. So the tax basis in the home will be reevaluated and stepped up to fair market values on the date of Larry's death, and that will be Terrence's new tax basis. So if Terrence the next week were to turn around and sell the home for that same fair market value, it would result in no tax due, since his tax basis equaled the fair market value of the sale. That's just a little illustration to show you sort of how that works in practice. I know we have about 10 more minutes left. Just wanted to wrap up with a few sort of tips and tricks and a couple of important points just to reiterate. The first thing you want to do as a business owner or a real property owner, make sure you have an estate plan in place. You want to avoid probate. You want to pass your assets to your kids or your chosen beneficiaries in the most efficient way possible, and that's done through an estate plan. So that's the starting point. Once the estate plan's in effect, you want to make sure that you transfer your shares in the business or your interest in the partnership or the LLC, as well as any other applicable assets to the trust to make sure the trust is funded correctly. As I said before, it's very important to kind of sit down and determine what your goals are for your business and whether or not they coincide with the goals of your family. That oftentimes can inform your decisions going forward and give you a way to proceed. I would strongly encourage most business owners to execute a buy-sell agreement, just to have something in place that contemplates change of ownership, whether it be death, retirement, permanent disability, bankruptcy, you name it. It's a good idea to have in place. That way everybody's on the same page with respect to what happens if one of those triggering events occurs. I also think it's important for businesses to kind of periodically evaluate where they think their business is going to be in the short term and the long term. You know, especially with the rate of technology and, you know, COVID and all the other things. There's been so many curveballs lately that I think that's very important to sort of keep your eye on the future and see what opportunities and challenges your particular business or industry might be facing, and use that information to inform your decisions. And then finally, right now it's not probably as much of an issue for most people, but if and when the lifetime exemption amount for estate tax and gifting goes down, you may need to make some decisions whether inter vivos or gifts during your life is something that makes sense for you to avoid estate tax, depending on the size of your estate and the exemption amount at that time. So that is going to wrap it up for my presentation today. I certainly thank you all for sitting in on this. I know hopefully you have some time to scarf down a sandwich and check your NCAA brackets. I see we have a couple of questions and answers.
I think we have, I'll just jump in for you since you were doing such a nice job on the presentation and not following the Q&A. There's 2 questions in the Q&A and 1 in the chat, if you want to look there.
Okay, just give me 1 second. Okay, so there's one Prop 19 question. If the death is prior to the effective date of Prop 19, which was February 16th, but the real property is pending probate and has not been distributed to the heir, what is the effect of Prop 19? That is a very good question, and I don't think I have the answer to that at this point. I can certainly look into that and get back to you. My gut reaction would be that it probably would be subject to the Prop 19 rules, but I will make myself a note and go back and look at that for you. The next one, property tax issues seem to be increasingly important. We have gifting. So this one also has to do with property tax. I'm glad I threw the Prop 19 in there. This person asks, property tax issues seem to be increasingly important. If we had gifting or changes of ownership, perhaps with discounts of an entity owning real property, can we avoid reassessment for property tax purposes? Again, I don't know the specific circumstances surrounding the property or the business, but generally speaking, because Prop 19 is now in effect, unless it's a principal residence, I don't think the property tax can be staved off or excluded, unless you're trying to use something other than the parent-child exception. So there are other exceptions for property tax, not necessarily dealing with transfers of interest to the next generation. But again, I can, if you want to email me after the presentation and maybe go a little bit more in depth, I can try to help steer you in the right direction. And I think that's, oh, there's one question. Will these slides be available after the presentation? We are going to be putting this presentation, it's being recorded, and it will be on our website, kroloff.com. You can go there and hear me drone on again for an hour if you like. But the slides will be there as part of that. So hopefully that will serve your needs.
Jason,
yes.
just as your colleague at Kroloff, I wanted to let you know date of death controls. So if someone dies prior to February 16th, the law that was in effect prior to Prop 19 controls.
Well, there you go. That's Carrie Kruger popping in with her expertise. Thank you very much, Carrie.
Named Jamie BuySell.
Jason,
Right.
there's one more question in the chat. If you
Oh, okay.
click on the chat at the bottom and scroll up, I think you'll see
Okay.
from Liz Bokish.
Okay. Oops. I did something wrong. I don't see the chat button. I'm sorry. Oh, here we go.
Liz?
Chat. Yes.
Oh no, I was going to say we'll follow up with Liz for that one, which is fine as well.
Yes, I will definitely follow up with all of these questions in the chat and try to get you answers today.
All right. Thank you, Jason. And thank you,
again,
everyone.
I'd like to thank everybody for coming out and listening to me. And if you have any questions, please feel free to reach out and we'll go from there.
Great job.
Great. Thank